Investing in individual stocks can be an incredible way to grow your wealth, but it comes with a higher level of risk and responsibility compared to mutual funds or ETFs. When you buy an individual stock, you're not just investing in a ticker symbol, you are owning a piece of that real business. That means more control over your investments, but also a lot more risk. As a new investor, understanding the fundamentals is crucial to making smart choices. In today's video, I'll share 15 essential tips to set you up for success as a new stock market investor. By the end, you'll have a better idea of how to confidently navigate the stock market and make informed decisions. Let's get started. First thing you need to do is you need to understand the business before you invest. One of the most common mistakes new investors make is buying a stock without understanding the company behind it. When you invest, you're buying a piece of a real business. Make sure you understand what the company does, what its business model is, and how it generates a profit. If you don't understand the business, it'll be difficult to make informed decisions about buying or selling. Number 2, diversify to reduce risk. There's an old saying, don't put all your eggs in one basket, which holds especially true in investing. Diversifying your portfolio across different sectors and industries helps reduce risk. If one stock or sector performs poorly, your other investments may balance things out. Number 3, start small, then grow. It can be tempting to invest heavily when you feel confident about a stock, but it's wise to start small. Making smaller investments let you learn without putting too much capital at risk. As you gain experience and confidence, you can gradually increase your positions. Next, think long-term, not short-term. The stock market isn't a get-rich-quick scheme. Focusing on short-term gains can lead to poor decisions and significant losses. Instead, look for companies with strong long-term growth potential. Remember Warren Buffett's advice, time in the market beats timing the market. You need to research company fundamentals. Before buying any stock, do your homework. Analyze the company's financial health by reviewing revenue growth, earnings per share, debt levels, and key ratios like the price to earnings ratio. This helps you understand whether the stock is undervalued or overvalued compared to its competitors. You'll need to understand market cycles. The market moves in cycles influenced by economic conditions and investor sentiment. Downturns are inevitable and not always a reason to panic. In fact, they usually aren't. They're usually a good buying opportunity, especially if the company has solid fundamentals. Reinvest dividends for compound growth. If you're investing in dividend-paying stocks, reinvesting the dividends instead of taking them as cash can lead to a powerful compounding over time. This strategy significantly boosts your returns as your dividends buy more shares, which in turn generate more dividends. As a stock market investor, you need to stay informed and follow the news. Once you invest in a stock, stay updated on relevant news about the company and its industry. Regulatory changes, new product launches, and shifts in leadership can all impact a company's stock price. Being informed helps you know when to hold, sell, or buy more. This is a big one. Don't let emotions drive your decisions. Emotions can lead to poor investment choices. The fear of missing out or FOMO might tempt you to buy at the peak, while panic can cause you to sell during a market dip. Stick to your research and don't make impulsive decisions based on market noise. Dollar cost averaging is an excellent way to invest. This is when you invest a fixed amount regularly, regardless of the stock's price. This approach spreads out your investment, reducing the risk of buying at market highs and allowing you to benefit from dips over time. Many of us dollar cost average without even knowing it in our retirement accounts, where our companies take out a portion of each of our paychecks and automatically invest that on a monthly or bi-weekly basis, or however your company does it. You'll need to assess your risk tolerance. Be honest about your comfort level with risk. Stocks can be very volatile, and while they've historically offered good long-term returns, they can also suffer short-term losses. Only invest what you can afford to lose. You'll need to pay attention to stock valuations. Even great companies can be bad investments if you pay too much for their stock. Check valuation metrics like the PE ratio and price to book ratio to understand whether a stock is fairly priced. When investing in individual stocks, you'll need to monitor your portfolio, but don't overreact. It's important to check your portfolio periodically, but don't stress over daily price fluctuations. Create a review schedule like quarterly or semi-annually, and only make changes if there's solid reason to do so. A technique you should know about is called stop loss order, where you automatically sell stock if it drops to a certain price, protecting your investments from severe losses. It's particularly useful for locking in profits when a stock price has risen significantly but might be due for a pullback. And last, and this one's also very important, you need to understand the tax implications. Remember that profits from selling stocks are subject to taxes. Holding a stock for more than a year may qualify you for lower capital gains tax rate. Understanding the tax rules can help you make smarter investment decisions.